Good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation or anything I'm talking about here tonight, jump on the phone lines, give me a call, 627-7979. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air. 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interest ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m. And that's to reach out and help as many people as we can in the Hampton Roads listening area achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone, give me a call, 627-7979, whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, TSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance. We are here to discuss tonight. 627-7979. All right, tonight we're going to talk about reverse mortgages, a much misunderstood financial product. So I thought I'd come here to dispel a little of that misinformation and tell you about the key features, the benefits, and some of the things to watch out for if a reverse mortgage is for you. So first off, what is a reverse mortgage? Well, it is a special type of loan that is available to homeowners age 62 or older that allows you to convert part of your home equity into cash without having to sell your home or make monthly mortgage payments. And then the loan is repaid when the borrower sells the home, moves out permanently, or passes away. So it's a way of extracting the equity in your house and turning an illiquid asset, your home, into a liquid one, being able to reach in, grab that home equity. And they differ from a traditional second mortgage or home equity line of credit in that you don't have to pay it back until a qualifying event later in life. But you don't have to make conventional mortgage payments on a reverse mortgage. And when they were first introduced into the marketplace, they kind of came out of the Wild West and an unregulated environment, and the early days of reverse mortgages were not consumer friendly, to say the least. And so they did garner a bad reputation initially because many people were not offered terms on their reverse mortgage that were conducive to a proper functioning product. So I'm trying to be very delicate with my words here. They were not properly designed in the first place. And so they kind of got a bad reputation. But that got cleaned up through the years. And now they are a very viable and useful financial planning tool. So a little bit of history. The reverse mortgages have been with us since the 60s, believe it or not, the 1960s. The very first reverse mortgage was done in 1961 by a savings and loan bank in Portland, Maine. And it was a direct private arrangement between the bank and a widow to help her stay in her home after her husband's death. And so obviously came from a really good place and can be used for really good outcomes when used properly. And then through the 70s and early 80s, a handful of banks and insurance companies, and basically anyone who could make loans, offered similar type of products, but there were no standardized programs, no federal backing, no real regulation around them. And so a lot of people got taken advantage of in the early days of reverse mortgages. But then in the 80s, specifically in 1987, Congress passed legislation that was part of the Housing and Community Development Act that authorized the home equity conversion mortgage program, which is home equity conversion mortgage is just the formal name of a reverse mortgage. But the home equity conversion mortgage program was administered by the Federal Housing Administration, and then they created rules and regulations for all lenders to have to follow that standardized the process and made them much more fair to consumers. So the first FHA-insured reverse mortgage loan was made in 1989, and since then, the program has helped strengthen consumer protections, standardize rules. They added FHA insurance to the program, which made reverse mortgages more accessible and safer. So nowadays, we do think that reverse mortgages have their place. There are a variety of ways in which they can be used. They offer a ton of flexibility to borrowers depending on what your objectives are, and I'll get into some of those later. But there's a lot of creative ways that a reverse mortgage can be used. So one of the biggest, problems that a lot of people have is they may have a fair amount of net worth, but a lot of that net worth is tied up in the illiquid asset of their primary residence. And we often say, well, you can't eat your house, right? So you can't just break off a shingle or two and take it up to the bank and trade it in for cash. So the only way to get that equity out of an illiquid asset is to use some sort of loan program or to sell that asset, sell your house. And some people do that. Sell your house, downsize, unlock some of that equity, purchase a smaller, cheaper residence, and then you have that excess cash. But then there's a ton of people who don't want to move out of their homes, and especially later in life. And so this program, some of the key features of this program and reverse mortgages, again, borrower needs to be at least age 62 or older. You probably need to have significant home equity. I would say about at least 50% of your home equity needs to be available, and it needs to be on your primary residence. So no vacation homes, no rental properties. Then the most common type of reverse mortgage is the FHA insured home equity conversion mortgage. There are different programs. There are basically any way you want to slice and dice it these days, you could probably figure out a way to get that home equity with a delayed payback, let's call it. Payment options. So how do you get your money? Well, once the loan is completed, you can get your money in a lump sum, one big pile of cash at closing, or you can get it distributed out to you on a monthly basis. So almost like an annuity payment over the next 60 months or 10 years, say, or some period certain. You can have those mortgage the loan payments paid out to you on a monthly basis to supplement your household income. You can have it as a line of credit. So similar to a home equity line of credit, you can have a reverse mortgage line of credit. So just like a home equity line of credit, it's kind of like a credit card. You get approved for a dollar amount. You don't have to borrow a penny. until some other point in the future, which means you don't have to pay any interest on the loan until you borrow it. And then you reach in and then you can, grab a chunk of your line of credit and use it for cash needs. Or you can combination of all three of them and somehow tie that all together. So however you want to receive the money, usually there's a way to do that through a reverse mortgage. And then again, no monthly payments required on a reverse mortgage. The loan balance will grow over time as interest gets added to the loan. But one thing that people always are concerned about, the borrowers or their heirs will never owe more than the home's value. So a lot of people are concerned, well, what if I have to sell the home and I can't pay off my reverse mortgage? Not to worry, there is insurance built into the mortgage program that would cover the difference if that were the case. And so a little bit more specifically, loan to value, the amount that you can borrow on your property is based on your age, interest rates, prevailing interest rates, and FHA lending limits. And so older borrowers can generally qualify for a higher percentage of the home's value. And then typical starting loan-to-value ratio is around 35 to 40% that you would be able to borrow at, say, age 62. So, for example, let's just say you got $1 million home, you owe $500,000 or less. That means you could probably qualify for a reverse mortgage of about $350,000 to $400,000. Now, whether you get that paid out in lump sum or you just establish a line of credit, those are some numbers to how much you could potentially borrow when it comes to a reverse mortgage. All right, we're going to take a short break. After we come back, we're going to talk about some of the benefits and some of the pitfalls to watch out for with the reverse mortgage. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can check us out online at wealthwayadvisors.com. All right, tonight we're talking about reverse mortgages, a much maligned financial planning tool that has seen improvements, enhancements along the way, where nowadays we feel this is a very viable and useful financial planning tool for a variety of reasons. So to recap a little bit more of the benefits of a reverse mortgage, they provide supplemental retirement income if needed. You get a range of flexibility in how funds are received at closing for the reverse mortgage. No required monthly mortgage payments. You don't have to make monthly payments. You don't have to pay back your reverse mortgage until a qualifying event, until the house is sold. Okay? You can get a line of credit. You can get it set up as a line of credit, and that line of credit will grow over time with the home's value. So one of the techniques that we like to put in place occasionally for our clients is, even if they don't need the money, go ahead and establish a reverse mortgage line of credit. Don't borrow anything at this point in time. No interest accrues, yet that line of credit will continue to grow over time. So say you start at $100,000. Well, the next year you might be able to borrow $105. The year after that, $110. then 115. So the line of credit will grow over time. And then when you actually do need the money, then you even have more available to you than you originally started. So we do like that. The cash can be used for basically whatever you want to use it for. There are no restrictions. It can help cover health care, living expenses. You can eliminate your existing mortgage. That's also an option that people don't realize is possible. Let's say for some people, they might be having a hard time making their mortgage payment later in life, living on just Social Security and maybe a little bit of savings. Cash flow is tight. You want a way to, but you want to stay in your house. You don't want to sell, but you need more cash flow. Well, you can get a reverse mortgage to pay off your existing mortgage and stop your monthly mortgage payments. So some of the advantages that we have from reverse mortgage, it obviously can help improve cash flow in retirement. The proceeds that you receive from the reverse mortgage are tax-free because it's a loan. It is not income. No tax implications to the money you receive. That has planning opportunities as well down the road. You can reduce sequence of return risk for retirees drawing on investments. Okay, what the heck does that mean? Sequence of return risk. Well, for people who are living off of their investments, like most of our clients at Wealthway, when we go through a market downturn, which is normal and natural, in fact, about 14 or 15% is the average intra-year decline in the U.S. stock market. That means anywhere in the calendar year, it would be expected that we would see at least a 14% decline in the U.S. equity market. We already saw one this year back in April. Wonder if anyone remembers that. Probably not. We're at all-time highs right now. But that did happen early in the year. That's normal and natural. So when you are drawing from your investment portfolio to provide income to supplement your lifestyle, then when we go through a downturn, if that downturn is deep enough, if it's takes too long to recover, and we're starting to eat into our principal too much and jeopardize our long-range spending plan, then this was a good time. A reverse mortgage is a good time to take money from that instead of your investment portfolio when values have declined, say 20 or 25%, because each withdrawal you're taking out then becomes a little higher percentage of your portfolio. And a way of managing that sequence of return risk is to draw from another source than your portfolio when market values decline. And when we get the ultimate market recovery eventually, which will occur eventually, then you can stop taking money from the reverse mortgage and go ahead and turn on the spigot back from your investments. And that's how you can manage it over a period of time, so that to ensure that your money lasts your lifetime. And then the reverse mortgage offers financial flexibility and security for people who want to age in place, and this is a big one. This is where we see a lot of times a reverse mortgage coming in handy. People who, you are not taking me out of this house except for feet first. Gosh darn it. A lot of people have that mentality. That's fine. That's good. But then if you don't have the financial resources to get in-home health care or to remodel your home in a way that's safe and effective for elderly living, then a way of accessing that money is through a reverse mortgage that you don't have to pay back until the home is sold. Okay. How about some pitfalls or some things to watch out for when getting a reverse mortgage? Well, there are higher than typical upfront costs. That takes the form of loan origination fees, mortgage insurance, and closing costs. And the interest rate that you pay on the amount that you borrow, it tends to be a little bit higher than prevailing mortgage rates. So there is a premium involved for a reverse mortgage. So you need to know that up front. The loan balance increases as interest accrues, somebody's going to pay that loan back at some point. So you need to be aware that it's not free money. It's a loan. Interest accrues. It does reduce the amount of home equity that is available to heirs. A lot of times we'll hear people say that, if they want to spend their last dollar on their last day, but the kids can have the house when I'm gone. Okay. Just know that if you borrow against that house, then there will be less to go to the kids because the loan will be paid back out of that home equity. Then also, borrowers must keep paying your property taxes, your homeowner's insurance, and maintain the property in decent working order. You can't let your home fall apart because that would reduce its value and then put that loan in jeopardy. So you got to keep paying your property taxes, insurance, and maintain the property in good working order. And then you have to be aware that moving out of the house for any reason, such as into long-term care, or if there was a calamity like a flood, or you had a fire and you had to move out, that can trigger the home sale. All right, got to take our news break right here. We'll be back in just a few minutes. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. Or if you got some nuanced questions, want to speak to a live human being, give us a call at the office, 456-2200. Want to remind everybody, our next live show will be on Tuesday, October 14th, and that is 3 weeks from today instead of the usual 2, just the way the calendar falls this month. So next show will be Tuesday, October 14th, but can't catch us live every second and fourth Tuesday of the month at 6 p.m., get this show as a podcast. Search for Dollars and Common Sense wherever you get your podcast. Download us, take us with you where you go, and listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors. Hit that like or follow button, and then once every week or two, we put up an interesting and informative financial planning post to keep you engaged in the process. Okay, 627-7979 is studio line if you want to jump in on the conversation, or if you have a question relating to your own personal financial situation, I'd love to hear from you. Tonight, we're talking about reverse mortgages, much maligned financial product through the years that has cleaned up its act and is ready for prime time now if used responsibly. So, what are some of the uses for a reverse mortgage? We kind of went through the mechanics in the first half of the show. Let's talk about some of the reasons why you might want to use a reverse mortgage. Well, are you looking for additional ways to protect yourself from outliving your assets or to support your living expenses? So, if so, you want to consider establishing a reverse mortgage line of credit, because as indicated earlier, that will grow gradually over time. You don't have to borrow from it when first put into place, and you have it at your disposal when you need it. Or you can set up the reverse mortgage to pay out a lifetime income stream every month or every quarter. Get a deposit right into your bank account to supplement Social Security, supplement a pension. You can also tap that home equity in your house, and you don't have to pay it back until you move out of the house. Okay, how about another reason why you might want to consider a reverse mortgage? Are you concerned about having enough cash or liquidity to handle spending shocks or unexpected expenses? Now, we would say that's what your emergency fund is for. An emergency fund is defined as anywhere between 3 to 6 months of household expenses set aside safely in a bank account. I know that's not earning much money. That's not the purpose of that type of money. It's for safety, security, and backup. But if you don't have enough emergency fund and you're struggling to find the way to build the emergency fund, then a reverse mortgage could help you out. You could consider establishing a reverse mortgage, again, line of credit as an additional emergency fund. Just resides in the background, there when you need it. How about if you have a traditional mortgage, are you concerned about the demand it has on your cash flow, right? That's something I talked about earlier. Some people are able to make ends meet later on in life with just Social Security and their savings, but they don't have a whole lot left over, but they do have a house they've lived in for 20, 25, maybe 30 years, got a lot of equity in it. Good use of the reverse mortgage there. What you do, essentially get a reverse mortgage to pay off your existing first mortgage, and the payments stop. You don't have to pay it back. You don't have to draw any more than the first mortgage if you don't want to, but you can get a reverse mortgage that with just enough to pay off that first mortgage and make those mortgage payments stop. How about for people a little bit more creatively now? Do you want to delay taking Social Security benefits? Right, so you can take Social Security benefits as early as age 62, Social Security retirement benefits, as early as age 62, or you can delay till as late as age 70. And roughly every year that you delay, the benefit increases about 8%. So that when you do eventually draw the check by delaying, you're going to get more Social Security each month for the rest of your life. So if the circumstances are right and it suits your needs, delaying Social Security can be a good strategy to help try to maximize Social Security benefits over your lifetime. And if you don't have enough cash from the time you retire to when you want to delay the Social Security benefit, taking the Social Security benefits, then you can bridge that gap with a reverse mortgage, taking the equity out of your home now, and you don't have to make payments on it. Your house will pay you. How about, do you need help supporting health care or long-term care needs? So, this is common for a lot of people in America these days. They don't have many outside assets. They don't have a large savings to draw from, but they do have a house that has value that they've lived in for a significant length of time, and they have no desire to want to sell that house and move out. Well, the reality is that those people at some point in their lives are probably going to need some level of long-term care, whether that's brought into their house in the form of healthcare aides that come to your house and attend to the homeowner, or it's in making the house conducive to safe living in your older years, maybe putting a bedroom on the first floor, installing a ramp around the house to get in and out of the house easier, maybe a chairlift to get up and down the stairs. Those things obviously all take money, but you can use a reverse mortgage to access that home equity and allow you to age in place. Okay, how about concerned about feeling pressure to withdraw from your portfolio when markets are down? That's what I talked about earlier about the fancy term sequence of risk, withdrawal risk, sequence of withdrawal risk from your portfolio. So in the occasional temporary periods when market declines are impactful and they are real, They do happen from time to time. About 1 out of every 4 calendar years, we see a negative return on the U.S. stock market. The average intra-year decline of the stock market, 14 to 15%. In those normal, natural, occasional, temporary declines, then accessing your home equity through a reverse mortgage can help preserve more of your portfolio so that when we do get the eventual market recovery, there's more left in your pot. There's more to withdraw from. Your withdrawals in a down period are more detrimental to the long-term health of your investment portfolio. So if you can pause those, temporarily pause them or reduce the amount of withdrawals in the portfolio and protect it for the future, you use the money from your home equity to help bridge that gap when that happens. How about, are you concerned that your heirs will not inherit your home if you use a reverse mortgage? That's a myth that is still persists that's out there, that if you get a reverse mortgage, then you think that, well, then the heirs will not get your home. No, you are still the owner of your home with a reverse mortgage, just like you are with a traditional first mortgage. You own your home. You are on the deed. Now, you might have got a mortgage to help you buy that home, and you are liable for that mortgage, and you have to pay it back. And so the mortgagor puts a lien on your property so that if you don't make the loan payments on time, then they can seize your property. Well, the opposite is true with the reverse mortgage. I should say that you still have a lien on your property, but you don't have to pay it back until the home is sold or you move out of it permanently for some other reason. So that is a real concern, right? If you have elderly parents that this applies to them and they need to go to a long-term care facility, then after a length of time, and it's usually about 6 months, if the homeowner is not able to move back into the property, then that could be considered a qualifying event, and then that might cause the sale of the home and the repayment of the reverse mortgage. Now, I also say in practice, anecdotally, we have seen that reverse mortgage lenders are often very willing to work with the homeowner, and what they care about is that your property retains its value. So as long as the property is being maintained in good condition, the roof is being fixed, the yard is being mowed, the utilities are being paid, the property taxes are being paid, you still maintain homeowners insurance, it's still kept up in the neighborhood, then that's what they care about most, and then they're usually willing to work with the homeowner and the homeowner's heirs or beneficiaries to allow you to maintain that home. But there's also the misconception that once you have a reverse mortgage, that the kids aren't going to get the house. And for a lot of older adults and parents, that's one of the things that they usually say they want to have happen. So the heirs will only owe, when they inherit the house, the lesser of the reverse mortgage balance, or 75% of the home's appraised value. And so, like I said earlier, built into the reverse mortgage package is mortgage insurance, so that in the unlikely event that the mortgage loan grew in excess of the home's value, so that when the home was eventually sold, there was some left over on that loan, the insurance kicks in and pays that off. So the house is still in the family. How much equity is left over in the house, well, that is going to depend on how much, if you still got a first mortgage, how much is that, and what did the reverse mortgage grow to? Those have to be paid off first, but then the rest of that equity will be passed to the kids through the transition of the real estate to them, and if they're so inclined to ultimately sell the property to unlock the equity for their benefit. All right, I'm going to pause right here for our last break. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. All right, tonight we're talking about reverse mortgages, the pros and the cons. We tend to think they have more pros these days than they do cons, but we do have to be aware of the risks that go along anytime we borrow, take a mortgage, put a lien against our property, or really with any financial product. There is no nirvana. Every product comes with its pros and cons. So we just want to be mindful of those areas that could be a little bit risky when it comes to a reverse mortgage. So here's some planning risks that you should consider before you take the plunge. Is there a high probability that you won't stay in your home for a extended period of time? So if you intend to move in the near term, I would say 3 to 5 years, then probably a reverse mortgage won't make good financial sense. The costs and expenses built into the loan package will probably not be fully recouped over a 5-year period. If you're going to move, and when you sell the property in that period of time, that's when the reverse mortgage is going to get paid off, and it's over and done with. And so it probably might not have accomplished too much. So you want to kind of be in the home for at least 5 years or longer. And then you want to be mindful, of course, that moving, other than for some qualified medical reasons, will cause that reverse mortgage to come due. So want to stay in the property for an extended period of time. Okay. How about, are you in an area, neighborhood, or region of the country where the price of real estate is flat or declining? If the property were to decline in value, then it could end up in a situation where the loan is worth more than the property. Now, again, you are not going to be liable for that. We've already discussed that. There is an insurance, there's mortgage insurance that is packaged into the loan that you pay for, the borrower pays for. So, there is no free lunch. But that insurance will help pay off the loan in the event that you owe more than the home is worth when it does get sold. But by getting that home equity or the reverse mortgage line of credit, it's a great way to attach a borrowing limit to your property that in most cases is going to grow with the rate of inflation, even if your property value stays stable or declines. So just know that there's a little nuance there for areas with declining property values. Do you need to review the impact that a natural disaster could have on your reverse mortgage? Do you live in a accident-prone area? Well, if you live in Hampton Roads, you do. They're called hurricanes, and they're real, and they cause significant damage. If you live in the Outer Banks of North Carolina, too close to the Atlantic Ocean, and your house is in danger of being washed away, which I think we're up to 12 now on the Outer Banks of homes that have been reclaimed by the ocean. Well, Guess what? If your house is wiped out, that's when the reverse mortgage comes due. So it would have to get paid off at that point in time. Obviously, the property would be virtually worthless. That's when the insurance would kick in. But just know that that would be the end of the reverse mortgage if you had that type of calamity. Interest rates. Okay, so interest rates, we are still in a very favorable mortgage interest rate environment. A lot of people still don't think that because we're in the sixes on 30-year fixed rates, but historically that's still a very favorable rate. We just got spoiled with 2s, 3s, and 4s for about a decade before now. But interest rates do have an impact on how much you can borrow. The higher the interest rates, the less you can borrow, or the faster that the interest would be added to the loan balance. So that means the less that you would be able to pull from that line of credit at some point into the future. So just know that interest rates do have an impact on reverse mortgages. The lower the rates, the better, as with most borrowing mechanics. The higher rates, the less you're able to borrow. That all gets factored into the calculation that the mortgage lender would do to determine how much you ultimately can borrow. You want to make sure you're aware of the upfront and ongoing costs associated with a reverse mortgage. So there's some of the usual suspects, just as there would be with a refinance or a 30-year fixed rate first mortgage. So you're going to have a loan origination fee. You're going to have initial insurance mortgage premium. So you're paying mortgage insurance on this. That helps protect the loan. There's going to be closing costs, the lender's margin. So that's the little increase in the interest rate over and above prevailing rates. And then there's an annual mortgage insurance premium to go along with the initial insurance mortgage premium. All those are real costs that will get added to the loan. Then you don't have to pay out of pocket. You don't have to pay a single penny out of pocket. You just add it onto the loan balance, and then it will get paid somewhere down the road. And then one last purchasing issue. If your home is worth more than about $1.1 million, then you want to consider whether a proprietary reverse mortgage may be a better fit for you. So that's sort of like a customized type of reverse mortgage. That's all the time I have for tonight. I'm going to be back in 3 weeks on Tuesday, October 14th. Until then, I'm certified financial planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.
And paid for by Wealthway Financial Advisors. We are solely responsible for its content.
Summertime in Hampton Roads. Boating, golfing, fishing, beach time.